Right, looks like we're getting everybody onto our webinar. Welcome everybody. Welcome along to our peer-to-peer investment education webinar. My name is Heather Kentsley. Some of you may have met me or spoken to me or had an email from me, and those of you who don't, I'm the investment manager here at Southern Cross Partners and been here about just over 11 years now, which seems like a really long time. So we're really great to be able to bring this webinar to you. We normally do lots of different webinars along the time, but we thought it was great to be able to have a look at where New Zealand is, what our economic outlook is like, given all these COVID restrictions that we've got at the moment. So wherever you are in the country, if you're out and about enjoying things, then that's great for you. And those of us in Auckland, unfortunately, a bit more locked down with the hair getting a bit longer. The vast majority of our team who are Auckland based are doing everything they normally do just from their kitchen table or home office. So, we're keep on getting on like we normally do at the moment. And today we're really great to be able to have Christina Leung along with us. You've probably seen her name in some of our newsletters we've sent out. She very kindly helps us, get a good picture of what's happening in the economy at the moment. Christina is the principal economist and head of Auckland business at the New Zealand Institute of Economic Research. That's a big, long title. So she knows what she's talking about. Then after Christina and I are going to have a little chat about the economy, I'm going to hand over to Cam, who's one of our managing partners. He'll give you an overview of some of the trends that we're seeing across the business and in the loans aspect that we're talking about at the moment. Before I start talking with Christina on what we're going to be talking about today, just want to remind you that this is really general in nature. It's not tailored to anyone's particular objectives or circumstances. So, we always recommend talking to a financial advisor. If you have any queries about what you should be investing in, this is purely talking about where we're at the moment, and then we'll talk a bit about our specific product. And we will be recording this as well. So if you do have to pop off or for some reason you want to go back over what we've talked about, then we'll be sending it out on a newsletter so you can look at it and you can share it with your friends and family. So hopefully that's all my bit I had to do at the beginning there. So welcome, Christina, and thank you so much for joining us. It's been a huge year. And what we've noticed is that, of course, we were getting back to normal, and now we've got these extended lockdowns, which are happening to sort of snap as they come about. What we want to really know is, what do you see in store for the New Zealand economy ahead? How is this going to be affecting us?
You're right. What we've seen over the past year is just how quickly things can change, especially with this new Delta variant. But what we've also seen over the past year is that the New Zealand economy is very resilient to the external shocks and the challenges. And with the huge amount of government and support, and also from the Reserve Bank, the economy has responded very well to that. And with the combination of wage subsidies, increased government spending, and low interest rate, what we've seen is that has helped to support a recovery in demand across many sectors. Now, particularly so in the construction and the retail sector. And then, of course, it's been a bit uneven as well, the nature of this recovery. Of course, with the continued border restrictions, that has had a negative impact on the tourism and education sector.
Yeah, and of course, that tourism sector, could very well affect the job prospects and the unemployment. Although I did hear that unemployment was at a good rate. Do you have any comment about that at the moment?
Yeah, we've had very solid growth in the labour market, and as I was saying, with the New Zealand economy responding very well to all that monetary and also fiscal support. What we've seen is that labour demand has been growing, particularly with the continued border restrictions that's limiting the ability for firms to be bringing in workers from overseas. So with that, what we're seeing is very acute labour shortages, and with that, an increase in wage growth. Now, with this improvement in household income, that's also helped to support spending, for example, in the retail sector, also support the fact that people cannot be spending on overseas trips. We are seeing more of that onshoring in spending activity. And as the labour market has improved, what we're seeing also, yes, there has been some continued negative impact in the tourism sector, but we've also seen that the New Zealand economy as a whole is pretty resilient and adaptable to new conditions. And a lot of households and businesses have pivoted to new growth opportunities. So as this adaptation has taken place, we have seen that recovery in activity over the past year.
So I suppose being a smaller economy in a smaller country means we can, pivot, which is the go word at the moment, into different things. And you see lots of businesses being very innovative in how they get their customers during these lockdowns. We talked a bit about construction in there. So the rebound in construction has been absolutely phenomenal. Once those tradies could get back on site, they were certainly in there all over the place. And construction, obviously for our business, we lend a lot on developments and construction and housing. So how do you see the outlook for the coming year? What will the impact be on this level 3 that we've had on continuing construction activity?
We've seen very strong underlying demand for construction. And even with the latest lockdown, that has taken a little bit of wind out of the in terms of commercial construction, but certainly when it comes to residential and infrastructure construction demand, that remains very solid, reflecting the effects of increased government spending and also that catching up from the strong population growth that we've had in recent years. Now, what that's all meant is that the demand has remained very strong over the past year, but when it comes to supply, we're seeing a combination of labour shortages, also global supply chain disruptions, given the port congestion around the world. And then also with the continued lockdown in Auckland, that has impacted on the domestic production of building materials. So what we're seeing is this perfect storm of all these supply constraints leading to an acceleration in construction cost inflation. The latest CPI figures showed that in the September quarter, annual residential construction costs accelerated to 12%. In terms of what it all means for construction demand ahead, obviously, firstly, there's the physical constraints of whether there are the resources to keep up with the strong demand, but also with this acceleration in cost pressures, what we're going to see is some of that pushback against these cost pressures. Some developments might no longer be financially feasible, so you will see some developments start to be parked, and with that, we're more likely to see a more protracted construction cycle, just reflecting both the physical constraints and also a bit of that pushback from the demand side in response to that acceleration in construction cost inflation.
Yep. Absolutely. Yeah, we're seeing a lot of construction coming our way, and Cam will touch a little bit later on how we look at construction projects. Interesting, you talked about the supply chain with the ports around the world being so jam-packed, and of course not being able to the domestic supply of construction as well. Once we're able to get out of this lockdown and we can get back to some kind of normality, fingers crossed, do you think that we'll still have that limited, supply chain coming from overseas? And will that allow for opportunities with domestic production as well of construction products?
As the major economies start to open up, and that phrase learn to live with COVID, we will start to see that those supply chain disruptions work itself through. However, to the extent that there still needs to be a lot of catch up that needs to happen, given the amount of time that there's been this congestion going on around the ports, we do expect that to still remain to constrain growth over the early part of next year. In terms of the domestic side of things, what we've seen over the past year, for example, if we look at traffic flows, is that as restrictions are relaxed, we do tend to see activity bounce back to pre-COVID levels. So we would expect that to be the case again this time round. However, of course, the longer Auckland remains in lockdown for, that uncertainty that comes with that may start to hamper confidence and see businesses and households start to pare back on spending and investment.
Yeah. And of course, construction is all to do with housing. The housing market's so hot, and, this has an effect on interest rates. We're seeing some very strong inflation pressures in New Zealand economy at the moment. So what does that mean for interest rates ahead, but both, your mortgage rates and also investment rates?
So if we step back to what happened last year, there was the first lockdown, and in response to that, given the high degree of uncertainty over how the economy, New Zealand economy, would react to that, what we saw was the Reserve Bank cutting interest rates sharply back in March last year. Now, that along with the increase in government spending. As I was saying, the New Zealand economy has responded very strongly to that, and that has helped to push up housing demand and, of course, demand across a range of other sectors. And what that's done with the increase in demand in terms of outstripping the supply of available resources is that that's pushed up inflation pressures. So firstly, pushed up house prices, as we're all very well aware, but also when it comes to the broader inflation pressures, given that the resource constraints, what we've seen is price increases across the board. Now, the latest CPI figures that show annual inflation running at around 5%, and the predictions are that it will go up to around 6%. So that's well above the Reserve Bank's 1 to 3% inflation target band. Now, how the Reserve Bank responds to that really depends on what's driving that inflation. Of course, as we've seen with the oil crisis back in the 1970s, if it was purely a result of supply constraints, then it doesn't really make sense to respond with high interest rates, because you could increase interest rates, but what an increase in interest rates will do is it will make it more costly to borrow and to spend and invest. So you'll see that paring back in response to higher interest rates. But what we're seeing at the moment is that the high inflation is resulting from both supply constraints, but also stronger demand. And so the Reserve Bank is very mindful of the risk of this high headline inflation translating into inflation expectations being unanchored, as wanting to keep it around the 2% midpoint of the inflation target. So if we were to start to see, for example, businesses put up prices, and also households in their wage negotiations start to increase that in response to the high inflation, then you're likely to see high inflation become more persistent through the coming years. And that's what the Reserve Bank will want to avoid in terms of that change in longer term inflation expectations. So the Reserve Bank has started increasing interest rates with that increase in the OCR at its October meeting. And in fact, it had indicated that had it not been for the surprise discovery of community transmission back in August, it would have gone even earlier. And the indications are that it will continue to keep increasing interest rates over the coming year, just given how strong inflation pressures are. We expect 3 further interest rate increases from the Reserve Bank by the end of next year, and then for the OCR to reach around 2% in 2026. What that will likely do is start to, households and businesses will start to pare back on demand, just given it will become more costly to borrow and invest and spend.
Yeah, absolutely. And I think when you talked about pressures and on wages and also businesses putting their prices up, you definitely can see that's going to be the way people are going to have to recover from this particular lockdown. Put your prices up, ask for more money, and then when that doesn't quite work, they'll start paring down their spending. I wonder if savings might start to increase across the country. We're always a very spend first and save later nation, so perhaps this might help us get back into some savings. You never know.
That's right. And I would say, that with the first lockdown, it has made it more important for households and businesses to be building up a buffer, just because of the fact that it's very hard to predict what's going to happen over the coming years.
Oh, absolutely. And we've seen how some jobs are very busy at this time of lockdown. Others are very vulnerable. And I think people we're looking at what they do, how they do it. And this is the time where lots of innovation comes about. So it can be a good time in the economy for some people. Talking about, inflation and how that's going to affect interest rates. What do you predict, if you've got a crystal ball there, what do you predict for house prices going forward? Because they just don't seem to be, stopping or flattening off at all at the moment.
So we do see quite a few headwinds for the housing market. So firstly, from that higher LVR restrictions, higher interest rates being on the cards, as I was talking about with the Reserve Bank indicating that it will look to keep increasing interest rates over the coming years. And then also with the removal of the interest deductibility for property investors, and also the extension of the bright line tests for capital gains tax to 10 years. So all these things do make housing a bit of a less, when it comes attractive as when it comes to property as an investment. Of course, with any investment, it comes down to the cost of borrowing versus the rate of return on investment. And over the past year, as we've seen that sharp decline in the interest rates, which means that the cost of borrowing has been very low, it's made housing as an investment that much more attractive. But as interest rates start to increase, and with that, the cost of borrowing, you will start to see that more start to be in balance. And overall, it does suggest that it would take some of the heat out of the housing demand. Now, in terms of what it does to the level of prices, we do expect that it will still remain elevated, although with that strong residential construction, we will see new housing supply come on board. Overall, with the labour market still expected to be very strong, this improvement in household income should keep house prices at an elevated level. So while we would expect a moderation in the rate of house price growth itself, when it comes to the level of house prices, we expect that the strong labour market will keep that elevated. Of course, what we also seen over the past year, I guess one caveat is that house prices are notoriously hard to predict. I would say most were thinking that ahead of the first lockdown, there would be a plummet in house prices. And what we're seeing is actually the opposite. And that is because the economy was responding to the feedback in terms of the support that the government and the Reserve Bank went in to support the economy. And with those low interest rates, we saw that. So what that shows is that the government and the Reserve Bank would be reluctant to raise interest rates at too aggressive a pace if it was to see that it would start to have a detrimental impact on the economy overall.
Oops, it looks like you might have just lost Christina there for the economy. Are you there, Christina? Yeah, just dropped you off a little bit.
Oh, apologies for that. So yeah, as I was saying, house prices are notoriously hard to predict. And what the past year has shown is that the government and the Reserve Bank would be mindful of not wanting to be too aggressive in tightening policy in response to high inflation pressures if it would start to have a detrimental impact on the overall New Zealand economy.
Great. That's awesome. It's so great to see just to have a really good overview. We hear lots of things in the media, you read in the paper, you see on the internet, you see on Facebook, and we get lots of information coming from all sorts of places. It's hard to know how to filter it to really understand what's going on. So hearing from you, putting it into the context which is relevant for our investors and for our business has been really, really beneficial. We can cut through all that fluff and get right to the nitty-gritty. So it's been awesome, so insightful. Thank you for joining us today, and thank you for your insights that you put into our newsletter. We will look forward to more of these little snippets and gems coming through as we do more newsletters across the time. So we'll have some time for questions at the end. So if you have anything that you has come up through this little chat we've been having that you'd like to know about, type it into the chat function and we can cover it off at the end if there's some burning questions that you do have. I'm going to pass over to Cam now, who's going to look at the trends in our business specifically.
Awesome. Thank you very much, Heather and Christina. So yeah, my name's Cam Harper. I'm one of the managing partners here at Southern Cross. So very much appreciate all of you coming along today. So I'll just give a very brief overview. We did a webinar many of you may have attended or seen back in August, I think it was. Seems so long ago, it might have been September. It seems so long ago since we've been in this lockdown, isn't it? Right across the country, and then obviously for those of us who are here in Auckland. But it's a little recap, I guess, of Southern Cross Partners and how we work. So this is a business that's been operating for almost 25 years, founded by Barry and Julia Millwood, our founders, and they're still involved in the business every day. We have our shareholders are all New Zealanders based here in New Zealand, which is fantastic. And they all, in general have very, well, not in general, we do have very good guidance and very good bunch of people that help run this operation. But first of all, I think the important thing up front is we are licensed to provide peer-to-peer services by the FMA, the Financial Markets Authority. So they have oversight on what we do. They audit us every year. We're also audited financially. We do a yearly audit, and then we have interim audits through Baker Tilly, Staples Rodway. So they also do audits on that. So we're audited very heavily, and our last, and bring it on every time we say, so we do everything as well. We have full-time compliance officer. Many of you who are investing with us would have gone through the AML certification before you end up coming through and doing all that with us. So that's all part of what we do and how we operate. We always be upfront with everything that we do and everything that we expect, so that you know what to expect from us as well. But for Southern Cross, with our business model, we essentially a business that's, it's actually quite interesting. It's two disparate sides that come together in the middle. So on one side, we have our lending team. So they work with financial advisors. In the old days, we called them mortgage brokers, but financial advisors are registered, and they're going through and have been going through a very strong process to get themselves up to the applicable level of financial advice that's required for them to be able to give financial advice, whether that is for mortgages or investments or anything else. So we work exclusively with financial advisors with that team, and they'll go out and source the best loans we can. There's some outstanding loans that are sitting out there, and I'll talk a bit more about that in a moment. But once we find an applicable deal or loan that we think we might be interested in, we put that through a very, very rigorous process. We have our business development managers will get that going, and then we also have a credit team, and quite often one of us, like myself, who managing partner, or Barry, our managing director and founder, we'll also cast our eye over some of the ones that we sort of are a bit unsure about, and we'll peer review it within the business as well to make sure we're all actually happy with that loan. We kind of have a policy, I guess, where we look at it and go, you know what, if someone's not happy about this, we just won't do it. And you don't want to be silly about it, but we want to make sure that we only select the best loans to be able to go out and do that. So once we've done all that, it goes up on the investment portal. Obviously, we have our team that process everything through the middle and do an amazing job right through to drawdown. And then that goes up onto the investor portal where our investors can see that. And right now, rates always change. They're subject to availability as well as our minimum investments. But as of right now, our minimum rate is 5.5%. Our interest is paid monthly, and that just goes direct to your nominated account. Every now and then there are compounding ones, and so that will mature at the end, but you can get further details on that from our team or from our website. And the minimum investment amount at the moment is $10,000. So as I say, we've been going for 25 years, but we've learned a lot over that time. And also having Christina on board with us doing some writing for us is helping us immensely as well. So I just want to go through a couple of trends that we're seeing in the world of lending. And the first one we're seeing is there are more and more financial advisors coming directly to Southern Cross partners rather than going to the bank first. So what would happen traditionally, we're always known, and for those of you who've been in this business for a while or been around this for a while, we were originally, I think it was known as non-conforming, I think it was, or a non-bank, and there's been all sorts of things, and second tier, third tier lending, all this sort of stuff. And many of us have memories to the old days where there were non-bank lenders that went to the wall and took people's money with them. That's not, since the advent, obviously, of the Financial Markets Authority, that has weeded out a lot of these outfits. And as I say, the other thing I didn't say in this as well was, future performance can't guarantee future performance at all. But up until now, today, no investor has ever lost any money with Southern Cross, and that's something we're very, very proud of, and we'll continue that obviously as we go. But as I say, you can't predict what's around the corner. There's risks with any investment, and I'd encourage you to talk to any financial advisor to find that out. But we did have people come to the banks, used to go to the bank first, then they would come to us afterwards. But a lot of borrowers are actually finding it's easier to come to a specialist lender like Southern Cross Partners first. They understand what we do, they understand how we do things and how we operate. And we also pride ourselves on only taking the best loans and actually turning that around and giving an answer to our borrowers as quickly as we can. So our business development managers, we have 3 of them, 2 here in Auckland, 1 in Wellington, and they are outstanding at what they do, very, very good at what they do. And they have full discretion to just say, look, that loan is not for us. This is the reason why. And they also have discretion to actually start assessing that loan and then put that through to the team to go through to that drawdown. So what that means is it actually turns over a lot quicker. We can often get a loan offer out rather than weeks or months. We'll get that loan offer out generally within a day or 2. And so the borrower knows exactly where they're at, exactly when their drawdowns are going to occur, and exactly what's in front of them. So that makes life a lot easier for them. And we also like to do our loans based on what our investors are after. There's no point in us doing some random loan out the back of nowhere that none of our investors want to pick up. You know, there's no point. I mean, there's some beautiful parts of the country, but you know, we like to get our sweet spot to be where our investors are going to pick those up and give you guys good investment opportunities. But you know, we like to make sure that our borrowers are solid. You know, we do a lot of repeat borrowers. We're doing that more and more now, and we want to see a clear financial plan as to how they're going to go away from us to then move forward. We are a short-term lender. We do a lot of bridging finance. So typically our loans are about 12 months. And so quite often we'll get someone who'll come to us. They might want to buy an investment property, or they may not have, they may have a new business rather, and they can't get to the bank until they've got some audited accounts or some end of financial year accounts, I should say. And they'll come to us and we can see what their plan is. We can see what's going to happen. We can see how they're going to exit the loan. A lot of our construction lending will see how they're going to exit the loan. It'll be through selling at the end, and we can just see what that looks like. So that's really important to us. And we often see, another one we'll see as well, as equity releases on a house. Someone's built a house, or they have their own, have a home they have access to, and they will do an equity release on that to start up another project, maybe buy an investment property, or to go ahead and start construction or buy a section for that construction. So very clear on the loans we look for. Our sales team understand exactly what we're trying to achieve. Everybody in this business has a shared goal, a shared vision of how we're going to make it work. So we don't have anybody kind of going on random tangents or anything like that. And most of those loans, as I was saying before, come through people we worked with in the past. Now, another trend we're seeing is the huge increase in construction loan applications. Okay, I mean, those of you who are from the South Island, from Christchurch, you'll have seen that on the Christchurch rebuild, the amount of construction that took place. Through Wellington, it's been going for a while. In Auckland, I wouldn't say it's a new phenomenon, but it is something, something we are seeing in Auckland is just the sheer amount of infill housing. You know, Auckland has been an undersupply of houses for a very, very long time, but the face of our city is changing very, very quickly. And we are seeing that. But, you know, it's generally you'll see somebody, it's a larger section, it's got one house on it, that house gets demolished and there'll be 3 or 4 or 5 terrace properties go on there. We don't do lending for large projects. You know, we're talking $15, $20 million. We don't do those. We're not set up for that. We don't like doing those. Generally, we look for loans that are under $4 million. At the moment, we've got a lot of applications coming through. I've actually pared that back a little bit in the last few days. So we're not taking applications over $3 million at the moment, just to make sure that our investment opportunities are regular for our investors, and to make sure we don't get too much exposure on larger projects. Something Christina was talking about earlier is something that we are very, very conscious of. And, you know, I was describing it to somebody recently. It's a bit like, you know, you feel like at times you're almost in a game of musical chairs. And you don't want to be the guy that's standing there with no chair at the end. That's not what you want to do. And I'll do a bit more on that in a minute. But, you know, we see a lot of people as well. We're seeing more and more, we're seeing neighborhoods getting together. So there might be, you know, some people at number 3, and then you find that, you know, number 5, Main Street or whatever the street is, they get together and they sell their houses together because they can sell it to a developer. Or the guy over the back comes and knocks on your door. Hey, I've got this person looking to do that. Would you be interested in selling as well? We're seeing more and more of that happening quite regularly. But, you know, something you need to realize with our construction lending, We do site visits and we meet the borrowers, and we meet the builders. We make sure that we understand exactly who it is that we are lending the money to. We go right down to if we don't feel like it's right, if there's something that makes us think there's something we're not comfortable with about this, we're not comfortable, we don't do the deal. It's as easy as that. We want to make sure that we get high performing loans that are going to perform, they're going to finish when they say they're going to, and they're going to make it work well for us. But demand for construction remaining solid, as Christina was saying, that's absolutely something we're seeing firsthand. So we've got to keep a tight handle on that. So those rigorous checks we talk about, making sure that there's nothing wrong with the builder, that the builder hasn't got some case hanging over them or something unusual happening with them. Making sure the developers, people, we're trying to work more and more with people we've worked with before to make sure that they have performed in the past and they are going to perform again. Working with financial advisors who we've worked with before. If we get someone that rings us up with an urgent deal that we've never heard of before, they want to settle next week, the answer is no. No, we're not prepared to do that, because that would mean that we're going to put that investment opportunity up to our investors and we're not backing that ourselves. We've got to make sure that we're happy to put out what we're going to you guys, to our investors, what it is that we are happy to lend on ourselves. And also our maximum LVR, loan to value ratio. So I think I explained this last time. What's the value of the house? That's $1 million. We're loaning them 600,000. So the LVR is 60%. Yeah. So we don't go above 65% on construction. We just don't go above 65. And so even in a slightly, if a market flattened, we're confident we've still got plenty of room to move. At 65% LVR, there's still plenty in there. We also have strong contingencies on all construction. Those contingencies, anywhere from 7.5% to 10% on all construction. So if they come to us with their fixed price contract and from the builder, and all the other things might be through groundworks or water care or whatever it is, the total loan comes to $1.2 million or 1.5. We have a contingency in there over and above what they're after to make sure that there's going to be enough money in case we hit those headwinds that Christina's talking about. And we're not going to kid ourselves to say there are no headwinds. There are headwinds, but by being conservative lenders and making sure we know who we're lending to and knowing what we're up for helps us. We also drill into making sure that they don't have any potential supply issues, both through, through their building supplier, whether that be the likes of Mitre 10 or Carters or placemakers or whomever that may be, and also for personnel. We know that unemployment rate, I think the other day, came out at 3.4%. We're in a very, very low unemployment environment at the moment, with obviously, as Christina was saying, without net inflow of overseas workers, it's hard for us to make that work. So as an economy, so we make sure these guys have actually got enough builders and enough leading hands, enough labourers, enough anybody to make this work. And we want to make sure, I was also going to say, once they pass all those tests, once they get through all the tests that we put in front of them, then we split that across multiple progress payments. So they'll have an initial drawdown. So what that means, they may settle the land. Day one, usually the LVR is around 50% on the completed value of the building, of the construction. And so we'll make sure that they can, we'll give them 50% on day one. Then the rest of it is progressively drawn, and we'll do site visits on that. To make sure we physically visit them. Our credit team have a huge spreadsheet that tracks every single construction loan. We also get photos and videos demonstrating progress that come through at that time when we get those drawdowns, when they ask for a drawdown, and we drill into them to make sure they are where they need to be. Because we want to make sure we know where our money and your money is going. That's very, very, very important on all of that. The other thing I was going to say in here, as well as, and I think Heather talked about it earlier, but I'll make sure I say it as well, is that, when we do a drawdown, we lend our own money first. Okay, so that's something that's very, very important. Often you'll see peer-to-peer people that will get you, the person turns up who wants to borrow the money, says, well, I need to borrow 100 grand, 500 grand, whatever it is, and they'll wait for investors to fill it up to get to that total, then they can draw down the money. We lend our own money first. So the money that we hold as Southern Cross partners, we lend that money to help them settle that purchase. So we want to make sure it's a good loan to then offer up onto our investor portal for you to then invest in. So when you're investing in that, and we take first mortgage over everything that we do, we don't take second mortgages, we don't have anything else like that, first mortgage on everything. Okay, so that's very, very important. Now, the last trend I wanted to talk about is something we're seeing firsthand as well, and Christina mentioned it, and it's increases in valuations. And trying to figure out valuation on property can be hard. You know, it can be really hard unless you know what you're doing. And we do know what we're doing, which is great. And you see national house prices increasing 26.3% year on year, according to QV in September. That's incredible. And we were talking about this earlier with Christina, that to understand what this housing market was going to do. I mean, if you all remember back to when COVID first hit in March last year and we went into lockdown, we're thinking, heck, what's going on here? You know, and a lot of banks at first were predicting decline. And look, in fairness to the banks, I mean, look, I'm not against banks. We love the banks because quite often people come to us first, then go back to the bank, right? The banks are often the exit strategy for our borrowers. But they were predicting a decline in the housing market. That didn't happen. In fact, it's been rampant. But, you know, all of us have been around long enough to understand this is cyclical. It will go up, it will go down. That's just basic economics and the way that property works. But, you know, you look at the average house price, it's now north of $900,000 in this country. Auckland, it's nearly $1.4 million. It actually feels unusual saying that's what the average house price in Auckland is, 1.4 million. And the valuations don't seem to be softening at all. And rising valuations do pose a risk. And so we need to make sure we mitigate those risks as much as we possibly can. So we need to continue, you know, those of you who know Southern Cross well know that we are a conservative company. We aren't aggressive at all. I'm just reading a question at the moment from somebody here. You might want to pick that up at the end. We'll just have a look at that, something about registered first mortgage. So we'll cover that off in a second. But I just want to make sure that, yeah, conservatism is the key to us. And that's what Southern Cross has always been, and we will always continue to do so, to make sure we are conservative. And that approach gives us the best decision for our investments. So, you know, making sure, like I said earlier, we know how they're going to exit the loan, that the loan term, the amount of time they've got the loan for, is realistic. We don't want somebody turning up and saying, hey, I want a 6-month loan, when in actual fact they need 12 months, because when we have to renew it, and there's a process behind that. We do renewals if they are performing, but you know, you want to make sure that you've assessed that loan correctly up front. And we want to make sure that the LVR ratio is conservative, like I was saying. Even for things like residential refis and equity releases on houses, we don't do 85%. In fact, to get to 80% is very, very unusual for us. It hardly ever happens. I can only think of a couple that we've done in the last couple of years. We don't do 90% LVRs. It's too risky. We just don't do that. Our sweet spot, the 65 to 70, maybe early 70s for the right deal. That is what we do. Valuations, we like to get valuations from independent valuers. And we have people that we will work with, and we have others that we just know don't do a good job, so we don't use them. It's as easy as that. So yeah, we may also use, depending on what it is, we may use a real estate appraisal, sale and purchase agreements. Sometimes we look at it if it's been bought at auction to understand how competitive that auction was and has the person overpaid for it. So we may, on the back of an auction, look to go, well, let's get a real estate appraisal as well. Sometimes we also, you know, you get a rating value or a comparative market analysis, also known as a CMA, to get that valuation. And the CMA estimates the value of the property by looking at similar recent sales around that area with similar houses. So quite often we end up with a number of different valuations, multiple valuations. So what we do with all of those, you might have, say, the property is 1.4 million, which I talked about before in Auckland is the average. You might get some that say, oh, this house is worth 1.3. Another one might say it's worth 1.6. Another one might say it's worth 1.5. So it's easy for the borrower to want us to do that on the 1.6 valuation. No, we take it on 1.3. We take it on 1.3. So we take it on the lowest valuation. We also find out what's the applicability of GST for them. Are they going to be claiming GST? Often with construction lending, yes, they are. So we will more often than not take the GST off unless we get a mandate to say that they're not going to be claiming GST and we're comfortable in that. But, you know, when we're lending at conservative LVRs, even if they did claim the GST for some random reason, which they don't, but if they did, we're still okay. So then we lend on the lowest value that we have. That's what we lend on. That's what we calculate everything on, is the lowest value. Again, making sure we're very conservative. So in a nutshell, continually rising valuations, it makes us stick to our knitting and more and understanding that as a conservative company, that's what we need to do. Stay conservative, stay our course. You know, it was before my time, but obviously this company got through the GFC relatively unscathed, and we are getting through COVID. In last year, you know, when that first hit us, I thought, oh my goodness, what are we up for here? This is going to be a wild ride. But you know, we stayed conservative. We got through COVID. None of our investors lost anything. Our investments still were solid, what we offered to our investors. And then with Delta coming here, I remember the day in August when there was an emergency press conference from the government about Delta alert levels. And I got up out of my office, where I'm lucky to be sitting here today, sort of on my lonesome in here. But looking around and going out to the team, they're all sitting out there. They're all now at home and doing their jobs. And said to them, guys, I'll see you in October. And they all just laughed at me. You know, who is this galah who's supposed to be a managing partner telling us see you in October? Well, how wrong I was. I thought I was being a bit silly. I thought I'd see them again. I thought we'd be at level 4 and level 3, 2, 1 as we have them previously. But then suddenly here we are trying to support each other and understand that we're going to alert levels, then we go to step 1s and 2s and 3s and then traffic lights. It's all a bit confusing for us, isn't it? But you know, the team is doing a very good job, but staying conservative is what we need to do. So look, the other thing also I wanted to mention before we go back to some questions is last time we did this, it's something we get asked about regularly, is hardships and arrears. And I think it's really important as investors to understand, for you to understand what are our hardships, what are our arrears, and how are those working. And those are available on our website, or you can talk to anyone in the team. They can direct you in the right direction to be able to find where those are on our site. They're published by our compliance officer, Jo. She publishes those every month. But as of right now, last time we did this update, which is August, I think it was the end of August, anyway, a couple of months ago, we had no hardships. This time I report we have one. We have one person, one loan in hardship. And unfortunately for them, they're just a victim of circumstance at this point in time. We're working with them. They need a better alert level to be able to start trading again. It's as easy as that. They are, like a lot of us, you know, waiting to get some clarity to when they can start trading. As soon as they can start trading again, which should be towards the end of this month, then we have a plan to get them out of hardship and get them back on the path again as soon as they can start trading them back on the right path. So it's a hardship application, or the loan in hardship, but in the way of hardships, it's a relatively good course for us to get out of it, or for them to get out of it, get back to regular repayments. And they're in a good place as well, and we're staying close to them to make sure they're okay. We judge our arrears on 30 days, so loans that are over 30 days in arrears. Last update was 0, we had none, and this date is the same. So we have no loans over 30 days arrears. We have 2 that are in arrears. One of them is in arrears by 4 days, and the other one is in arrears by 15 days. And both of those will be cleared up, if not late this week, early next week. So we'll be back at 0 loans in arrears. And I've got to say, you know, any company who is trading in this country, to have arrears that low would be very, very proud of that. And when we are, especially going through what we are through COVID, I think it's incredible that we can do that. So those are where our arrears and hardships are, and I think that's about where we are. So just real quick on that, the 3 things we're really seeing is people coming direct to Southern Cross rather than going to the bank. Huge amount of construction loan applications, but we are being very conservative and only taking on what we need to. We're not trying to overstretch ourselves. I think that's really important to understand. We're not trying to overstretch our strike zone or what we're capable of doing. We're very, very conscious of our own capabilities. And thirdly was the increasing in valuations and how we deal with it. Those are the 3 main things. So look, that's all from me now. So I think Heather and Christina will be coming back. So if you've got any questions, I don't know if there's anything you want to cover on those ones. But
Yep,
if you've got any questions there, you can go for it. And Heather, I guess you can take this back and go from there and have a look at those questions.
Yeah, there's a couple of questions here. There's one from John. Not quite sure if you can see that in the chat function there, Christina. If you wanted to comment on that.
Yeah, the one in regards to immigration and the impact on house prices, expected impact on house prices. Yeah, so that's a great question. Firstly, I guess the key thing to note is that over the past year, what we've seen is that demand for housing has remained very strong, even with those border restrictions. And what that really shows is the key influence of both the cost of borrowing and also that access to credit, given that with the sharp decline in interest rates, that's really helped to support that strong demand in housing. Now, in regards to immigration policy, the government has indicated that it's looking to reset immigration policy, as yet the details of which is not clear. But what it's important to note is that irrespective of that, what we've also seen over the past year is that with the border restrictions and also with the outbreaks in within the major economies, what we saw was a lot of New Zealanders also put their OEs on hold. And so what that shows is that as borders reopen, it would really depend on how the other major economies will be faring relative to New Zealand. Certainly, if the other major economies were to start performing stronger than New Zealand, then it would start to entice a lot of New Zealanders overseas and go on those OEs again. In terms of the surge in, so overall, I would say that yes, we will border reopening. The net impact is unclear, depends largely on what the government policy on immigration will be, and also on how other major economies fare and whether we get New Zealanders moving overseas as well. But also what we've seen is that with the expectation that the labour market here in New Zealand will remain strong, that will help to support house prices at a high level.
Great. Yeah, absolutely. And thank you, John, for that excellent question. We've got another question here from Nigel. To what extent do you think the increase in the OCR over the next year or so will manifest into the higher lending interest rates? And what do you think? Get your crystal ball out again, Christina. What do you think those interest rates are going to be?
Yeah, great question. And the thing if we look at over the history of the OCR versus, say, borrowing rates, for example, the Reserve Bank has a series on first mortgage rates, the retail mortgage rates, floating rates. And what we've seen is that as interest rates have fallen sharply, that spread between the retail interest rate and the OCR has increased. So what that means is that the banks have been passing on less of that OCR decline onto its customer in the form of lower retail rates. And so conversely, as the OCR increases, we would expect that spread to compress again. So just to give an example, currently the spread between the first floating mortgage rate and the OCR is running at around 4%. And we would expect that as the OCR increases, that spread would start to compress to around, say, 2 to 3%. So overall, the borrowing costs won't go up as high as the OCR increases. So in terms of our forecasts, we do forecast that the OCR is going to reach around 2% by 2026. And what that means for mortgage rates, we would expect to be running around 5%, just based on that expectation of a compression in the spread.
Great, excellent. That's great, thank you. There's another couple of questions, mainly about our interest rates. Do we expect our minimum interest rate of 5.5 to go up as the OCR increases? And our interest rates that we set for our investors are linked to our mortgage rates that we set. So, Ian, yes, I expect that our base interest rate may start to increase. As we start to perhaps increase our interest rates to our borrowers. That all very much depends on supply and demand. Cam, do you have any comment about our own increase in interest rates that you want to add to that?
No, I think it's just like you say, Heather. It's supply and demand. At the moment, through COVID, I mean, we're not a large company, so we need to make sure that pool of cash that we lend against. I was saying earlier that we lend our own cash first, our own money first to settle loans. We need to make sure that is turning over. So it comes down to, yes, it's a basic, the most basic of economic principles as to where those sit.
Yeah, absolutely. And now, if you know how we operate, or you're new to how we operate on a margin. So we'll charge the borrowers one interest rate. We'll take a margin in between, and then we'll offer an interest rate to the investors. That margin varies. It can be very, very small. It can be slightly larger. There's no set rate. It depends on the actual deal. So they can be varied. That's how that margin works. Had a question here about hardship, who pays interest to investors when borrowers in hardship. The one hardship we do have, Southern Cross Partners puts our hand in our own pocket, and we'll pay investors at present for the interest that they're expecting every month for that. That can change depending on how many we get, and we do have information on our website about how investors would be affected if they didn't receive their interest through there. So do have a look on our website for more information about that.
I was just going to add to that, Heather. We make sure that we have plenty of contingencies. So I talked about contingencies for construction loans. We have contingencies for, whether you want to call it a COVID contingency or whatever you want to call that. We do have that. So if we do see loans going into hardship, it's at our discretion as to what we do with our investors at that time. Many places just say, look, I'm sorry, investors, this loan's in hardship, you're not getting your interest payments. But as Heather was saying, at this point in time, with the loan that we have in hardship, we are paying that out of our own pockets, out of that contingency at this point for our investors to make sure that that is regular for you.
Yeah, and there's a very good question. I think that must be Bill Fergie on there, saying what happens to rollovers and end of loan dates when refinanciers have tightened their lending criteria? It's a really good question when one of our borrowers is going to exit our product by refinancing to another lender, to a bank, and what might happen to those. Cam, do you have any comment about how we would handle any of those borrowers that aren't able to exit through their normal channels they were expecting to?
Yeah, so it does happen every now and then. Sometimes, I'll give you an example. We had a loan application come in yesterday, and the person's exit was to go back to the bank. And we've all been around long enough to understand that banks' criteria is getting stricter and stricter, and that's their prerogative. That's what they do. And I looked at that one personally, came through to me, and I said, there's no way this person is going to get back to the bank. I just can't see how they're going to get back to the bank. So this is a loan that we will be stuck in, and it'll just keep going and going and going. So realistically, it's hard to predict what's going to happen at the end of the loan term. It really is. But we do have our renewal process. So we obviously look through the loan right at the very start. Then as it comes to renewals, our renewal manager will look at that a couple of months before it's due to mature to say, look, what's your plan? And if they do want to renew, we need to make sure they've actually got a good reason to renew. But if they don't, they've got a couple of months to make sure that they can go to another financier. Or sometimes people look at it and go, you know what, it's my investment property. I can't repay it. I'll sell it. And so we see that sometimes as well. They will actually end up selling the security to clear their debt, whether that to be us or to anybody else. So, look, if it comes down to it, and it happens very, very rarely, we do reserve the right, if they don't renew within a good amount of time, or if the loan is in arrears, we can PLA, Property Law Act notice, we can do that, which generally snaps people into line pretty quickly. Or worst comes to worst, and we try so hard not to go down this path, but we can go to mortgagee's sale if we need to be able to clear that debt as well. So there are a lot of options that we can take on. And there are other financiers around that are actually more than happy to pick up Southern Cross deals because they're not as conservative as we are. So there are a lot of other financiers that do pick up our loans at the end of their loan term.
Absolutely. And I think with the new renewals, I think we can expect, if you're an existing investor with us, you can expect perhaps, the loan that you're in, or the loans that you're in, may be renewed for 2, 3, 4, 6 months while the borrowers get their exit strategy sorted, because it's been disrupted so much with COVID. If they're building and they haven't been able to finish this in time, and they can't get the council out to do the inspection because there's a big delay, or they can't get valuations, or if they need to finish, they can sell. There's lots of reasons, and very valid reasons, why someone wants to renew their loan. And we do, as Cam said, look at it very, very thoroughly. And of course, if the loan's been performing and they've been paying on time and it's ticking away and the construction's been going on, there's really no reason why we wouldn't renew that loan. It's a good loan. It was good to start with. It's carried on being good. Then we just renew it, and the investor funds just renew along with it. So we don't renew loans that are bad or in any way going to go pear-shaped. We will manage those loans very, very promptly. But it's a good loan to start with. Why wouldn't we renew it? Your loan, your investment just continues. So it's a really good question about the renewal process.
Can I just add to that as well, Heather, that, you know, like I was saying before, we work with financial advisors. We're not working directly with the public. So we can put pressure onto the financial advisor to go, you need to find an alternate for your customer, for your borrower. You need to do that. And that's what their job is. Their job is to do the best for their customer. And they do. Most financial advisors are very, very good people and do care about their clients. So it's up to them. You know, we're not dealing directly with the end borrower. We're going through their financial advisor and saying to them, you need to find an alternate for this person. And they do.
Absolutely. I had a question here from Deirdre, which I'm just trying to find again, Deirdre, on the side here. It just asked about how you talked about first mortgage and how our investor funds secured. And yes, they are secured with the first mortgage on the title held in trust for investors. So as we talked before, if anything goes pear-shaped and they really can't exit from our loan or something goes wrong, we can issue that Property Law Act notice, and we can mortgage sale as a very last resort. And they will do, yeah.
And I just something I didn't touch on before is, you know, we have Southern Cross Partners, but all money that is drawn out of Southern Cross Partners in and out comes through another operating entity, Loan Investment Trustees Limited, or as we call it, Little in here. And so all investors have an account within there. So when you have, so all loans are drawn from there, and all investors are noted against that loan in our system. So whilst you don't have, you know, if I'm an investor, it doesn't have Cam Harper on the first mortgage. It has Southern Cross Partners LITL, and then the investors are noted in the account in the background. So, you know, I think it's important to note that you're investing as investors. You invest in the loan. You don't invest in Southern Cross Partners. Okay, so even if, I don't know, the worst happened, and I'm trying to think of the worst case scenario here. If you turned up to our offices here in Selwyn Road and Howick and the lights are off and I know there's some other person in here, your money is not invested in our company. Your money is invested in the loan. So what that means is somebody else, if we failed for some reason, this is part of being with the FMA, if we failed for some weird reason, can't see why, but who knows, right? Is that part of that, you have to have a fallover plan with the FMA. And part of that is that somebody else will come in and manage those loans to maturity. So when those loans do mature, you get your money back. So even if we, I don't know, ran away to the Bahamas or something, I don't know, I'm trying to think of weird stuff that could happen. Then what would happen is your money is still invested in that loan, and it would be then managed on your behalf by another company who steps in behind us to then take that through to maturity for you to get your money back, including your interest payments along the way.
Absolutely. Fantastic. I think we've probably covered all the questions that came up just now. And of course, if you're listening to this and you're live or you're watching it being recorded and you do have something, do drop us an email with some questions. Anything that you'd like to perhaps cover off in our next newsletter. Always looking for subjects that investors are interested in and want to know more about. So please do drop us a line to our investments email, investments@scpartners.co.nz, or give us a call at the office and we can have a chat about what you'd like to know about. I think that probably covers it. Lovely. Thank you so much, Christina, for joining us. It was lovely to meet you and hear all the insights about what's happening. So thank you so much. Thank you, Cam. And thank you to everyone for joining. And we hope to see you soon, and stay safe. Thanks very much.
Thank you.